UnitedHealth Group reported Q2 2026 earnings pre-market this morning, with Wall Street consensus sitting at $4.87 per share. The stock has climbed 8% year-to-date on the expectation that Medicare Advantage margins are in early recovery after a difficult two-year stretch. That narrative looked intact heading into today, until Elevance Health, one of the largest managed care operators in the country, beat its second quarter earnings and revenue estimates and watched its stock fall anyway. The reason? Medicaid reimbursement guidance that unsettled investors across the entire sector. UnitedHealth's print now lands in that context, and the two results are directly connected. To understand why Elevance's print matters for UnitedHealth, it helps to separate the two programs at the center of managed care economics. Medicare Advantage is the privatized version of traditional Medicare. Carriers like UnitedHealth enroll seniors, manage their care, and receive a per-member monthly premium set by the federal centers for Medicare and Medicaid services. It has been the primary growth driver for the sector for the better part of a decade, and UnitedHealth built much of its managed care franchise on the strength of that segment. Medicaid is a different animal. It covers lower-income Americans with reimbursement rates negotiated state by state, often subject to budget cycles and legislative priorities that have nothing to do with healthcare economics. When a state faces a shortfall, Medicaid reimbursement rates are frequently among the first items compressed. Elevance's Q2 results showed beats on both revenue and earnings per share, with Carelon on RX, the company's pharmacy benefits unit, cited as a meaningful contributor to the top line. But the sell-off wasn't about the quarter that just ended. Per Yahoo Finance's reporting this morning, management flagged that Medicaid reimbursement rates have been flat or declining in multiple states, and that the margin pressure from that dynamic is not expected to ease quickly. The market's response was unambiguous. Investors sold despite the beat because the forward outlook on Medicaid, a high-exposure segment for Elevance, came in worse than priced in. That reaction is what makes UnitedHealth's print this morning so consequential for the whole sector. For UnitedHealth, the Elevance read-through is real but not one-for-one. Medicare Advantage makes up a larger portion of UnitedHealth's insurance revenue relative to many managed care peers, and the Optum subsidiary, spanning pharmacy benefits management, care delivery, and health data analytics, generates revenue that isn't tied to medical loss ratios in the same way the pure insurance segment is. That diversification has historically given UnitedHealth more earnings stability in periods when managed care margins come under pressure. But UnitedHealth does operate a Medicaid book, and the same state-level reimbursement dynamics that Elevance flagged exist across the industry. UnitedHealth's scale doesn't make it immune. It makes the magnitude of any impact larger in absolute dollar terms. The medical loss ratio is the number that cuts through all of this. It is the percentage of premium revenue paid out as medical claims, and it has been the sector's central stress metric for 2 years running. Post-pandemic utilization normalization. More people scheduling procedures that were deferred in 2020 and 2021 pushed claims higher than insurers had priced for when they set 2024 and 2025 rates. The recovery thesis entering this year rests on the idea that carriers have since repriced aggressively enough to restore sustainable margins. If UnitedHealth's Q2 medical loss ratio is trending back toward historical levels, that thesis holds. If it is still elevated or moving higher, the Elevance read-through becomes much harder to dismiss. The macro environment adds a few layers. The 10-year Treasury yield stood at 4.62% as of Monday, per Federal Reserve data. And that matters for managed care operators because they earn investment income on the float between premium collection and claims payment. Higher yields make that float more valuable, adding a tailwind to investment income that partially offsets margin pressure elsewhere. The unemployment rate is at 4.3% as of the most recent reading, which keeps Medicaid enrollment elevated. More people qualify for the program when labor markets soften, adding volume to the government-funded book even as some state reimbursement rates lag that volume growth. The federal funds rate at 3.63% positions the sector in a higher-for-longer rate environment where investment float benefits are real, but borrowing costs for capital-intensive expansion remain elevated. 3 things to watch when UnitedHealth management speaks this morning. First, the Q2 medical loss ratio and how they frame its trajectory for the second half of the year. Second, whether full-year earnings guidance moves up, holds, or gets revised lower. That revision direction will tell you more than the quarterly beat or miss alone. Third, what management says about Medicare Advantage enrollment trends heading into 2027 plan year negotiations, because that is where the recovery thesis either gets reinforced or starts to erode. The consensus estimate of $4.87 per share is the number analysts built models around. But in a quarter where Elevance beat the number and still fell, the headline isn't everything. The margin explanation is what investors will be listening for.